I think finance availability is, as I said very early on, absolutely enormous at the moment. If you find the right lender, and I think that is now a big part of the jigsaw, you will get almost anything financed at in a secondary, tertiary city. We had a very major asset in a tertiary city with it was exceptionally large, and it had a tenant that had a little bit of a checkered history with the board being hauled in front of court because of bribery and stuff like this. So not necessarily what every bank wants to. We did finance it. It was the previous board, and sometimes you have to explain that matters change. We got through that. The question today is because the funding market is so more pigeonholed. Every bank has, and every alternative lender has a sweet spot. If you hit that and you present it correctly and explain why this fits, then you will get a very positive response and you get some very attractive terms. If you present the same thing with the same arguments to the wrong lender, you will get absolutely nowhere. So it has become much more binary, the reception you get. And on top of this, these things always change, because one house might have written a lot of residential in the first half and says, well, we're getting a little bit overexposed. Second part of the year, we want to write a little bit more commercial. So you have to stay very close to the relevant and very broad lender community, but then financing is available in spectacular terms. And that, I think, is my key concern. We're all talking about Brexit and what's going to happen in 2 weeks and everything else. I think my key concern is that some charming Italian gentleman one day wakes up in Frankfurt and says, what have I done? We can't go on QE like this. If I look at my balance sheet, I have anything from securities bicycle loans or whatever else on it. This is not a good loan book I have written. I think I should slow down. And then we are out of negative interest rate territory. And then we are out into being able to, that the banks, whatever they have, write it into nice packages and send it to the ECB for purchase. And then the bond purchase will stop, and we'll have a shift in the interest rate environment. And I think that is a much bigger risk than anything else, Brexit or anything else. And I think this little charming Italian gentleman holds much more power over your investment returns than you actually know at this point in time. And I hope he'll wake up gradually and don't have a big espresso in the morning, because then we all have a bit of an entertaining summer ahead of us.
Good, but isn't that the point? I mean, isn't that the point? I mean, the interest rates rising is that's the prophecy. I mean, that's what he wants to get. He needs to get inflation in line in order to increase. I mean, we can't be on a zero year policy or zero interest rate policy for that. So he's got to. But that's the point. And it just shows that we're still living in a deleveraged environment on a macroeconomic scale. Nobody wants the money, so hence why he's got to start putting the money into, or the banks don't want to lend it to a certain account. But the point is that interest rates have to rise at one point. I mean, that's the aim of the whole game, from our Italian friend. So that is a necessity. The question is what tempo, and with what kind of a horizon. And if that has a normal horizon too, to get back to a normal, I mean, just imagine 2.5% interest rate. That would be phenomenal. And if you can plan with that, that'd be nice. And it needs to start hiking up again, because you're going to have a different long-term discussion somewhere down the line when nobody has the savings to consume. So you have a whole different impact in 20, 30 years on real estate if it doesn't happen. So it'd be nice if he wakes up with a double espresso, but takes his time drinking it and adapting the policy.
Yeah, I think, Richard, we, not as much as Union, but we run a number of German funds that Internos bought off Commerzbank 3 years ago. And if you tell those investors you're going to give them cash back, they get extremely worried, because they get their cash, they put it with Deutsche Bank or Commerzbank. It costs them 10, 20, 30 basis points to park the cash. So therefore, they're desperately keen for you either not to sell or to reinvest. And of course, that's completely what's driving the markets. It's negative returns on cash, volatile returns on equities, very expensive returns on bonds. So as we know, so many pension funds around the world are running at big deficits. They desperately need income. Where do they go? Infrastructure and property. So as Philip said at the beginning, that's what's driving the market. I mean, capital is absolutely driving these markets. And that will continue until interest rates start going up or, Donald Trump arrives or something else happens. Don't underestimate the capital push. It's huge.